Welcome to the Psychology Talk podcast. We are your hosts, Dr. Scott Hoye, clinical psychologist,
and Kyle Miller, licensed counselor. Psychology Talk is a unique conversation about psychology around the globe. We speak with psychology experts to keep you informed about current issues and trends. We advocate toward reducing stigma and educate about mental health.
While you're listening, please take a moment to give us a review and subscribe on Apple Podcasts, Spreaker, or your favorite streaming service. It helps us to continue providing you with quality programming. And now, enjoy the episode. Hello, everyone, and welcome. I'm Dr. Scott Hoye. Today, my guest on the Psychology Talk podcast is Dr. Stanley Teitelbaum. Dr. Teitelbaum has been a practicing clinical psychologist for more than 35 years. Since 1980, he has been a training analyst and senior supervisor and faculty member at the Postgraduate Center for Mental Health and is also the Training Institute for Mental Health, both in New York City. He is also a founder of the Contemporary Center for Advanced Psychoanalytic Studies in New Jersey. Dr. Teitelbaum is the author of numerous articles in leading mental health publications and has appeared on more than 25 national television and radio shows, including Nightline, Good Morning America, 2020, and CNN. Today, he joins us to discuss his new book, Smart Money, A Psychologist's Guide to Overcoming Self-Defeating Patterns in Stock Market Investing. Dr. Teitelbaum, welcome to the Psychology Talk podcast.
Thank you, Scott. Nice to see you.
Okay. Well, I have done my due diligence, and I've been enjoying your book as a sometime amateur person who looks and dabbles in his own retirement fund and other things in the stock market. I found it very enlightening. Well, maybe you can just kind of launch in and describe the book and maybe why you decided to write about the psychology of investing.
Well, I've always liked money, but I never had any until I became successful as a psychologist. But I always had an interest in investing, and it's become one of my specialties in my private practice. And my own personal journey as an investor has been very sketchy, meaning that I had a lot of illusions about how I was going to do well in the stock market. And one of the ways I was going to do that was by connecting with a really good advisor who was going to lead me into the land of riches. And it took me a long time, I'll describe to you later, what I describe in my book as my 30-year odyssey with financial advisors. And it took me a long time to recognize the ups and downs and the ins and the outs, and how illusion can also become disillusionment, which happens to be the title of my very first book, Illusion and Disillusionment, Core Issues in Psychotherapy, which informs a lot of what I write about in this book on smart money. So at some point, I had already written a couple of the book that I just mentioned, and I wrote a couple of other books on sports and sports scandals. And then I veered into my other interest, which is the stock market and investing. And it took me a number of years to put it all together and to write the book. But the first thing I think that's worth mentioning for your audience is a couple of facts, which is that since 1926, when records were first started to be kept on this, almost 100 years ago, the average annual gain in the stock market, as measured by the Dow Jones Industrial Average or the S&P 500 index, has been almost 10%, actually 9.6% annually as an average gain. Now, that's a pretty good gain. Mm-hmm. However, the research indicates that the average investor during that period has had an average gain of only 3.2%. That's a whopping difference between 9.6% and 3.2% annually for the average investor. Mm-hmm. And so what I've come to discover and write about is that the reason for that discrepancy between the average annual gain in the stock market and the average annual gain for the average investor in the stock market is because of the ways in which people get in their own way, their own self-defeating tendencies, which leads them to underperform the general average gains. And the four biggest self-defeating patterns that I've discovered and described are buying high and selling low, following the herd, doing what everyone else is seeming to be doing, looking for the next guru, and staying too long with an unproductive financial advisor. And as we go forward, I'd like to have the opportunity with you to elaborate on all of these dimensions.
Yeah, absolutely. Well, I think the one of the things you kind of clarify or specify is kind of Cassandra Syndrome. What does that mean? I think that probably relates to one of those items.
Well, that's the old, that relates to the old Greek myth in which Cassandra was given a special power to foretell the future. And then that was taken away from her at some point. And so nobody believed her. So she became known as the Cassandra, who people wouldn't listen to, even though she had a lot of good insights into the future. Mm-hmm. So what I describe as the Cassandra Syndrome is the awareness about the history of the stock market, which is very useful and very informative and very important. But if people don't pay attention to that or don't listen to the history or don't follow the history, it's like what the philosopher Santayana once said, for those who don't listen to history, they are doomed to repeat it.
Yeah. And so...
So the history of the stock market is that there are cycles. There are bull markets and there are bear markets and volatility and gyration within the cycle. We've been in a very extraordinarily long bull market pretty much since 2009 until now. And so people tend to forget, or many people tend to forget, this is a Cassandra Syndrome, people tend to forget that the party doesn't last forever and that it will cycle into correction territory, which is happening right now as we speak, and even further potentially into bear market territory. That's part of the cycle. Yep. But what's also important to remember is that there have been studies that show that in any 30-year period since 1926, the stock market in a 30-year period, as measured by the S&P 500, has never had a losing 30-year period. So that speaks to the importance of being in the stock market and staying in the stock market, because that's really a good place to be putting your money. And if you can be in it over an extended period of time, like a 30-year period, like let's say, for example, the 30 years between 1983 and 2013, which included two very, very treacherous bear markets. Yeah. 2000 and 2008, terrible, treacherous bear markets. Nevertheless, in that 30-year cycle, the stock market nevertheless had a gain, taking those 30 years together. Mm-hmm. So that's an important thing to remember. The other piece, and then I'll let you go on, but the other piece is if we look at the average annual gain in the stock market, it seems that even though, as I said earlier, even though there's the average annual gain of 9.6% per year, That's an average. And it's really interesting to note that in any given year, it's rather unusual. It's rather unusual for there to be a gain or a loss between 9 and 11%.
Okay.
So what that means is that in any or every given year, there's a very high probability that the market will overshoot or undershoot its average.
Okay.
So for example, in 2021, the market was up 27%. In 2020, it was up 20%. That's an overshoot. Right now, it looks in 2022 that we're heading toward an undershoot.
Okay. Yeah. But that you call that a correction, right? The market correction, right? Mm-hmm. Because what are some of the things that are playing into that? The average listener out there who's not a psychologist or who's a psychologist who's looking at their retirement funding, whatever that is, in whatever capacity. What would you say is going on now? Like you're saying, it's a correction period. What do you think is driving that? I mean, I think the media is saying inflation's driving that. The Fed's going to raise interest rates, so people are panicking. I mean, let's not even get started about crypto, right? I mean, what's going on there? But some people have described that as a Ponzi scheme, or possibly the new gold, or maybe both. But what do you think is driving the current selling off?
It's all the things that you're mentioning. Those are very real things. Mm-hmm. The other thing is that we are so overdue for sell-off, because it's been in such a positive trend for so long now. People have been saying for 4 years, 6 years, 7 years, we're due for a pullback. And then there's a little pullback, and then it goes ahead and it goes forward, and it goes forward into new territory. And it's this new records. So I think the other factor is that, what goes up at some point also comes down. The question is, how much will it come down?
Yeah. Let's kind of pull back a little bit, because you've provided a lot of information about the history of the market and how it basically stays. It has dips and highs, but it also kind of has that general return over a period of time. What you said, 9.6%. Part of what you describe in the book, that selective amnesia, that, what's happening now blinds people, the exuberance of the current trends in the market, blinding people to what is up ahead, right? You kind of talk about, you use an analogy of like getting into a traffic accident where the driver was looking, but they failed to see, right? Kind of cognitive processing, for those out in the psychology world, it's top down versus bottom up, you might say. Like you're not taking in the information and you're attending or projecting, if you will, what you would like to see, or what you think you should be seeing onto things. Maybe you could describe that a little bit further.
Well, the selective amnesia also has to do with what we were talking about a moment ago, which is tuning out your awareness or knowledge of past performance and past trends. Mm-hmm. So that gets back to this, what I call the Cassandra Syndrome, forgetting about the history of the market, forgetting about past up and down trends, and things of that sort. Mm-hmm.
What else about that kind of cognitive distortion or processing could you say?
I think many investors also are in a illusion of wish fulfillment. Mm-hmm. I know from my own experience and many clients that I've dealt with, they had this fantasy, or they had this wish that I will invest and I will connect with someone who is also going to become my investment guru, and that will lead me into the land of riches. And as we have some success, that kind of gets reinforced. That notion becomes reinforced, and people tune out more of the reality of the cycles, the bear market and bull market cycles. It's like I have a quote that I wanted to read to you. It was from John Bogle, who's the founder of Vanguard, and Bogle, who said, "When there is a gap between illusion and reality, it is only a matter of time until reality prevails." In other words, if you're an investor, or let's say a new investor, and you have the illusion that, well, I'm gonna plunge into the market, and my illusion is that the market is a great place to make money, and I will become increasingly wealthy over time. If that's the illusion that many people share, and then that gets reinforced by success last year and the year before and the year before that, then you kind of tune out the reality of the 9.6 rule, what I call the rubber band effect, the overshoot and the undershoot of the 10% of the average annual gain. It's like a rubber band that expands and snaps back to where it belongs. And so that's the reality. And when that conflicts with the illusion of this is going to be a upward train ride, not a train wreck, then ultimately reality prevails.
Right. So the reality testing in the market like is going on. Yeah. Your book, I mean, you listed some topics. I don't know if you wanted to elucidate from any of the other topics you mentioned. I also have some questions too, but if you wanted to step in.
I could go on for a while, and then I'm more than happy to have you pepper me with your questions, and see how I might be able to answer them. But I did want to mention the rubber band effect. I think one of the a couple of thoughts that I have. There's a writer with Barron's by the name of Stephen Sears. He's also written a book on the stock market. And he says that the primary principle in investing in the stock market is not to lose. It's not about how much am I going to gain, he says. It's about how am I going to protect myself from losing. That's an interesting thing to tuck away in the back of our mind and work with that. Stephen Cohen, who is one of the most successful hedge fund operators in history, has stated that his portfolio managers are very successful. However, they are right in their stock picks only 55 to 60% of the time. That's fascinating. Only 55 to 60% of the time are they right, but they're very successful. How are they successful? Why are they successful? Because they're able to cut their losses. This is a very basic principle that I write about throughout the book. The discipline. Discipline is one of the most important factors in being a stock market investor. Having the discipline to cut your losses. In real estate, it's about location, location, location. In stock market investing, it's about discipline, discipline, discipline. And discipline means establishing a strategy that works for you, which takes into account your level of risk and risk appetite and tolerance for risk and tolerance for loss. And discipline means having that strategy and sticking to it, whatever it is. So like in cutting your losses, one of the periodicals that's very popular is Investor Business Daily. They promote people should take an acceptable loss if their stock goes into losing rather than goes into negative rather than positive territory. They should take an acceptable loss of 8%. Now, I happen to think that's a little, that's kind of tight. And probably you could extend that or expand that somewhat. But at some point, with discipline, you have to be able to say, I made a mistake. I thought this was going to be a good investment, and it's going south rather than going north. And I have to be able to cut my loss at a reasonable level. Mm-hmm, mm-hmm. I do that myself with many investments, especially recently. You mentioned crypto earlier.
Right.
And in the throes of the euphoria of cryptocurrency and Bitcoin, I did something against my basic principles, which was to be more careful. And I took a very small position in one of the cryptocurrencies. And like I got in and it went up a little bit and then it went down and then it went down. So at the point when it went down about 10%, I said, this is too speculative for me. This is too speculative for my tastes at my age, at my level of awareness. This is not a smart thing for me to be in, along with my other more careful and conservatively picked stocks. And so I got out. Mm-hmm. Now, so I sold at a loss. Now, people don't like to take a loss because the pain of the loss, research has shown, the pain of the loss is 2.5 times as great as the joy of a win. That's a very interesting statistic.
Well, it makes sense. I mean, if you take into account, the literature of research psychology and maybe evolutionary psychology, people's anxieties, right? They come about because of their fear of the future, and they're trying to predict what's going to happen. And I think that we learn in the world outside when we're running away from lions and tigers and bears, or the bully on the playground, you avoid certain things quickly because you associate pain with them. Animals do, all mammals kind of do that, right? I think even snails do that to a certain degree. It's been shown they have a kind of memory for that. So I could see how that might skew your perceptions in the market if you work more with your emotions and your reactance to things, right? You have to kind of have a grander perspective and picture of what's going on, thinking about things. Yeah.
It hurts. And so there are some like famous athletes like Jerry West, who's a former basketball player. He said the pain of losing hurts much more than the joy of winning. And even Tom Brady of the Tampa Bay Buccaneers has said the same thing very recently. Like, I don't get as much relief from winning as I do get despair or pain from losing. That hurts much more than the joy of the winning. So there's that factor. And then there's the shame factor, which enters into, there are all of these emotions that are related to stock market investing. There's the fear, there's the greed, there's the euphoria, there's the overconfidence, there's the regret. And I think mostly the shame factor, which means if I believe that I'm making an investment that's going to be a good one for me, I really like this stock or this company and the stock, and then it doesn't work out, and that now I'm in losing territory, not in winning territory as I had anticipated. If I sell my position at a loss, I'm going to feel some shame, meaning that what is shame? The definition of shame is exposure. Shame means being exposed to yourself and to others as deficient, as lacking, as not good in some way. In other words, I'm going to be exposed as not a good investor, not a good stock picker. And people want to avoid that. People want to avoid that. So one of the things that they do when they get into losing territory is they do something that a term that I've called, it's called get-evenitis, which is like a chronic disease in which you've invested in something, you're hoping and expecting it's going to be a winner, and now you're in losing territory. And what do? Do you sell? I don't want to sell because I don't want to have to experience the pain of the loss. And I don't want to have to experience the shame of what it means to be taking a loss. And what about the shame of if I take the loss and then if the stock goes up, I'm going to feel double shame. Now I'm going to feel shame for having sold it. Now I'm going to feel ashamed for having not stayed with it as it's now climbing its way back up. So that becomes an emotional problem. And the way many people handle that is they don't take the loss, or they make like a mental bargain with themselves. And the mental bargain is, I'm at a loss now, but I'm going to wait and hope for my stock, for my investment to make me even. When I get back to even, then I will sell it. I'm not going to sell it at this loss. I will hold on to it and hope that it's going to come back, and at some point I will be even, and then I will be able to sell it without the shame and without the pain. The problem with that is that market trends being what they are, is that often small losses morph into large losses. So if you don't execute the loss, and a loss is not a loss until you execute it, it's just a paper loss. If a paper loss becomes a real loss, then you're dealing with the pain and the shame. But if I don't execute it, I'm holding on to it, hoping to get even, then I can manage that, then I can handle that. But it often happens that a small loss morphs into a larger loss, and then you're in deeper trouble.
Okay. Yeah, so a stock that overnight almost becomes penny stocks is something that really can hurt a person's financial outlook, yeah.
I'll give you an example of that from my own personal history. When I was first starting out, a psychology consultant of mine who was very knowledgeable and knew a lot about everything in statistics and everything in psychology, and he also knew something about the stock market. And I was young and just beginning to invest. And he said, I have this, I took a position in this great new company. Probably I shouldn't even mention the name, but this many decades ago, the company doesn't exist anymore.
Okay.
He said, but this is a great new company. And he was so exuberant, so enthusiastic. He said, Stan, you this is what you ought to do that. Well, I didn't have a lot of money, but I had some money to invest, and I was just starting out. And so I took a position in this stock, and it was like a new issue, and it was $5 a share, $5 a share. And this was a company that several divisions, but one division had to do with a fertilizer that created sweet potatoes the size of watermelons. It was unbelievable. I went to the annual meeting, which was held in a hotel in mid-Manhattan, and they brought all of these sweet potatoes that were the size of cantaloupes and watermelons. This was a fantastic company. So I bought my position. It was $5 a share, and I watched it, and this was like a miracle. This was so great. The stock went from 5 to 30 to 60. Within 2 years, the stock was now 95. Went from 5 to 95.
Wow. Yeah.
When does that ever happen? That doesn't happen. That was like too good to believe. And it was too good to believe because then it cratered. Then it crashed. And it went down.
Were these legitimate sweet potatoes? I mean, like
Yes. Yeah. They gave out samples. They gave out samples at the annual meeting.
You could feed the 5,000 with a sweet potato. Yeah. Right.
It was terrific. It was beautiful. It was wonderful. and I brought them home, and it was great. But something went wrong with their business model, and the company cratered, and the stock cratered. The problem, and the reason I'm mentioning this, is that on a personal level, it was very difficult for me to accept this trend, to accept the 95 now at 75 or 55. So I put a call into the company, and I said, well, what's going on? And the administrator that I was able to reach and speak to reassured me. And this was more than one call. And it's fine. It's going to be fine. We're in a blip. Long story short, it just cratered and cratered and cratered. And finally, ultimately, it went out of business. It was something about, so I lost my $5, but I also lost my illusion about what $95 a share really meant. So that was a good personal example for me about the illusion and the reality. And for whatever reason, this stock crashed. I was not able to accept along the way down that this was not good. I need to protect myself a little better. Maybe not take my loss, take my gain at a good level, and be satisfied and be happy.
Turn that 95 cents a share into something more profitable elsewhere. Yeah. Your book kind of talks about the demographics of investing, which I found pretty fascinating. Maybe you can speak to that.
Well, I think what you're probably getting at is one of the main demographics is that women tend to be better investors than men.
And you mentioned that they don't even realize it. Majority of the time, they don't realize they think that men are better investors because of the cognitive bias, right?
Exactly, because of the cognitive bias. But the truth is that women study, and more than one study, many studies have shown that women are better at investing than men are, because they're more cautious. Women are more cautious. They are more risk averse, and they trade less frequently than men. They're less impulsive. They trade less frequently than men. And it seems that people who trade more frequently, I'm not even necessarily talking about day traders here, but people who trade more frequently tend to gain 7% less on average than the average investor. So there's something about frequent trading that also can be disastrous.
Well, that doesn't speak well, because when you have like a lot of people who are getting into, like, I guess, kind of like like amateur day trading with applications like Stash and Robinhood. I would assume that those applications are made to kind of potentially they're going to be like Facebook and set up on some kind of a reward system to keep you locked into the trading, and it doesn't. We could maybe that's another trail to go down, but like I'm thinking
that's another trail.
But I mean, not that they're bad in themselves, but they potentially could create stock market gamblers.
Right. That's right.
And so that's profit off of that. Yeah.
That becomes a risky business.
Correct. Yeah. But you did mention, like, these statistics that women tend to have this quality of they're risk averse more so than men, and they tend to stay in the game in a more subdued manner and get a better return probably overall.
Well, ultimately, right? they don't get a better return. This is
right. They're not as risk-taking, so therefore they're going to reap the benefits that the market can provide them at the normal return, right, whatever the return is for the time. Yeah.
So men invest more. So if you go back to the 9.6 average gain, right, men ultimately have more profits than women, but women are better in terms of what they invest and the percent of what their gains are.
And I think you even mentioned that Warren Buffett has been, stated as investing like a girl, because he takes a very subdued approach to the market with Berkshire Hathaway. And that's what's, the compound interest is what's helped him over time.
Right. That's right.
Some of the other demographic information, I mean, we did talk about how men are more risk takers, but that could be due to more testosterone and also cultural scripts about what men are supposed to be like compared to how women are supposed to behave. There's a lot we could unpack with that, but tell the audience a little bit about millennials and their approach to the market, maybe because of having experienced the 2008 crash. What do you think's going on there?
Well, millennials seem to, I think there's some mixed reviews on the millennials. There are studies that indicate that the millennials see themselves as higher risk takers, but then there are other studies that show that their expectations about the market are more realistic and more in line. So it's a tough call to talk about the millennials.
Mm-hmm. Okay.
But there's a lot of, in terms of the demographics, there's also a lot of stuff about, as people age, as people get older, what should be the balance of their portfolio in terms of stocks and bonds. Mm-hmm. And there again, there's the conventional view that as you age, you should gear more toward a lesser amount of stock and a greater amount of bonds. But there are some recent studies that say, you know what, you can still maintain, the conventional view was to be 60% stocks and 40% bonds, which would give you the best ultimate long-term protection in an ongoing basis. Mm-hmm. But there are some recent articles that say, even with that, you don't have to, as you get older and older, you don't have to go into 10% stocks and 90% bonds. You can even carry more stocks in your portfolio. And some studies say that those pan out as well as some of the other recommendations. I would like to, if I, because I know we're on a time clock here, so I would like to bring up one other point from my own experience, which is what I call which has to do with the theme of staying too long with unproductive advisors, because that has
the guru thing, the searching for a guru is what you call it. Yeah.
Exactly. And I, like many people and many of my clients and many of my friends and many of my relatives, all have been guilty of that phenomenon. And it's the illusion that the guru is going to be my savior, the guru is going to be my rescuer, the guru is going to lead me into what I call the land of riches. And so I had like a 30-year odyssey of working with a number of different financial advisors. They used to be called stockbrokers, and then they are called financial advisors. And every one of them, in one way or another, disappointed me. They all disappointed me until at one point I was able to get enough sense to say, you know what, I'm also going to maybe try to do this a little more on my own. And I was able to establish a do-it-yourself approach and a do-it-yourself account. But before I elaborate on that, I just want to tell you a very quick story. So I was with one of the stockbrokers who was very personable, very likable, and I got to him through a friend who had also been working with him, who said, you know, he's smart, he's likable, he doesn't like to lose money. So I called him, and he invited me to lunch at a kosher Chinese restaurant. I had never been to a kosher Chinese restaurant in Manhattan before. So I went, and so I started an account with him, and I stayed with him, and I stayed with him for like a couple of decades, and he didn't lose a lot of money for me, but the account never went anywhere. And it just, dribbled a little forward and then plateaued and plateaued and plateaued. And at one point he said to me, and this is the point this has stayed with me forever. At one point he said to me, you know what, Stan, I have to tell you, I was questioning him about, well, how are you, what are you going to do next? How are you going to make more money in my account and others? He said, you know what? The truth is that I and my colleagues don't really know a lot more than the average investor like you knows. I said, no, come on, you're kidding. He said, no, I know you for a long time. You're someone I believe, I trust. I can tell you the truth. He said, it's really true. We don't know more than the average investor like you knows. And I said, are you serious? He said, yes, I'm serious. Well, I didn't believe him. And then I thought about it afterward, and I said, I didn't believe him. Why didn't I believe him? And the reason that I didn't believe him is because I didn't want to believe him. I didn't want the truth. I didn't want to believe him. I didn't want to dismantle him from my guru pedestal. I needed him on that pedestal.
Yeah.
So there's a lot of that feeling that goes with looking for the guru. Like if I have, it sort of goes all the way back when we're children, how we look to our parents to be the gurus, to guide us, to show us the right path in life. And so I didn't want to have to lose him on my guru pedestal. And subsequently I did. And then I did a do-it-yourself approach. And I also recommend this to many of my clients. Set up a parallel, if you want to stay with your financial advisor, set up a parallel account, a do-it-yourself account alongside of your FA account, financial advisor account. And over 2 years, track those accounts. And many people discover that because of the expenses and commissions and things related to the financial advisor account, they earn less money in that account than they do in their do-it-yourself account.
Okay. Really, I guess you were saying the quote earlier you mentioned about advisors being no better than 56%, 50 to 60% hit or miss, right? I think there's a quote in the book that I laughed at. Like, people that know, you could probably do just as good in the stock market with a financial advisor as if you paid a chimpanzee to throw darts at a Wall Street Journal or something. I don't know what the quote was, but there's a lot of myths about the marketplace because there's a lot of statistics that are bandied about, and probably financial advisors make their money off of confusing people. Some of them, I'm sure there are financial advisors who really like what they do and they believe what they're doing. Maybe what they're really doing is they're providing a kind of sense of security, if you will, a good object to hold on to, like that sense of security, like a mother or father figure who's taking care of you in the market. So you don't have to think about it. It's that sense of security. Yeah. But in worst case scenarios, you mentioned a worst case scenario, which also was a good example of how the Cassandra effect can really show itself or rear its ugly head, is around Bernie Madoff, who was the Darth Vader, right, or of Ponzi schemes, and so many people lost money trusting him and looking at the results that were impossible to be had. And who was the individual who you mentioned who had been reporting about it for some time? It's in the first chapter of your book.
Harry Markopoulos.
What's that?
Harry Markopoulos was the whistleblower.
Yes, the whistleblower ahead of time who was reporting to various news outlets. And he didn't even go to the SEC. And then there was fighting between the SECs, much like police departments tend to sometimes have this fighting between themselves.
Right. Yeah. He made 8 different attempts And he couldn't get anyone to listen to him or to take any action, even though there was so much evidence that he had about Madoff, which ultimately led to $65 billion in losses.
Which is horrific. Which I think about not just the investors who lost all that, but the ripple market on the economy, right?
Yep. Right.
Right. And
that's a classic. Yeah. That's a classic example.
Yeah. But it's this kind of searching for the guru who's going to, and the person who has the magic, the Midas touch, if you will, even though the Midas touch was a curse in Greek mythology.
The magic. The
magic. And there's no magic there to it, is what you're saying. So the book really is for just the average investor, but it also could be for people just to kind of enlighten themselves about the market. It's a very concise, well-written, engaging book that you have provided for people. Would you agree with that? It's for the average investor?
Yes, yeah. It is written. It is written for the average investor primarily. Mm-hmm.
Do you think it would be a good?
But the principles apply to everybody. The principles in the book.
Yeah. So it's very concise and to the point. I had some thoughts as I was reading it. Since we're both psychologists and we're both clinical psychologists, I wonder, how do you see the market affecting individual and community mental health?
Oh, I think it does a lot. I think many people tend to confuse self-worth with financial worth. In other words, if I'm doing great in the market, I feel great. It kind of gives a boost to my ego. And that makes me feel like a winner. Everybody wants to feel like a winner. So if I have a good portfolio, the successful portfolio, I feel more like a winner. And it affects me in a positive way. Mm-hmm. When I start to be when my portfolio starts to be more in a down cycle, as it is starting to happen now in this correction phase in early 2022, it affects psychologically, emotionally, it affects people as feeling less confident. It makes them feel less happy, it makes them feel more scared, more frightened, more nervous, more anxious. And then they worry about, should I sell? And then they get a deer in the headlights phenomenon. So I think the stock market affects how people feel emotionally. And it affects our ego, how we feel like winners or losers, but also it affects when we're in a down market like we are right now in early 2022, mm-hmm. Many people feel more anxious and they feel more depressed when they see that their portfolios don't have the same value as it did a month ago. Mm-hmm. So that becomes a problem. And then it affects their relationships as well. They become more irritable. Mm-hmm. They become sometimes more difficult to get along with. And so it affects their self-esteem and it affects their relationship as a result of the up and down phases in the stock market.
So do you think that investing skills can help people function better as well regarding their mental health?
Absolutely. Mm-hmm. Absolutely. Mm-hmm. If they have those skills, they will be more successful mm-hmm. and they will be less self-defeating, which will make them feel better, but also will give them better results, which will then feed into their overall mental health and self-esteem.
Mm-hmm. Well, as I was reading the book, I was thinking, probably proposing a general class in public schools to help people better manage their finances and learn about how the market works. I mean, I think that might be something that would impact the quality of their life to the better. We force everybody to take, U.S. government courses, right, to kind of teach about history and constitutional law. So what do you think? That was something that came up. Would you agree with that?
Wouldn't that be great? Wouldn't that be great if that could be introduced into curriculum early on, you know?
Yeah. Yeah, I think maybe that would be a way to kind of help people. Since we are a capital-driven society and a democracy, I think it would probably help the marketplace, people make wiser decisions, maybe stabilize it a little bit more, and increase public discourse.
Absolutely. I agree with that. Yeah.
Okay. All right. Well, I think on that note, we'll wrap up here. Thank you so much for your book, Smart Money, and that is available through your website. Is it also available on Amazon?
It is mostly available on Amazon. Yes.
Okay. We will provide a link in the show notes to that. Dr. Teitelbaum, thank you so much for joining the show.
Thanks for your interaction, Scott. I appreciate it.
Thank you for listening to the Psychology Talk podcast. This podcast is intended for informative and entertainment purposes only. If you need a mental health professional, please seek one out. All material, copyright, the Psychology Talk podcast. Music is provided by the oddly Italianate named band Serenati. Ciao.